Crocs reported earnings last month and the stock tumbled 14%, taking the stock price to just below $103 a share. At that price, the company has a market cap of $6.3 billion. It's got $200 million of cash and $2 billion of debt, so the enterprise value is $8.1 billion. Revenue over the last 12 months is $3.9 billion, which is 39% higher than at the same time last year, and that's thanks to Crocs' 100% acquisition of the HEYDUDE brand. The HEYDUDE brand now contributes 26% of total revenue. Net income is $669 million, with $1.1 billion of EBITDA and $750 million of free cash flow, and stock-based compensation is minimal at only $30 million. So Crocs is now valued at 8 times EBITDA, 10 times earnings and 11 times free cash flow. Looking at recent trends, you can see that earnings has been heading in the right direction, even though the stock price has seen some wild swings. The PE ratio has fallen to under 10, which is lower than its historical average, and gross margins have held nicely above 50%, which is excellent for a footwear brand. Last quarter's earnings report was also decent. Total sales grew 11% to over $1 billion, which was a new record, and net income margin increased to just under 20%. Sales in Asia also took off, climbing 33% year over year. So why has the stock fallen? There are perhaps 3 reasons. First, Crocs has over $2 billion of long-term debt thanks to its acquisition of HEYDUDE, and this is costing the company $170 million of interest payments a quarter. Second, total sales of HEYDUDE grew only 3%, which may have been lower than investors were looking for. Third, many investors are simply skeptical of the Crocs brand. They see the shoes as a fad that could deflate at any time, and that's why the stock rarely trades at a high multiple. However, HEYDUDE did see solid e-commerce growth, and today the company refinanced a chunk of its debt pile, reducing interest payments by 0.5%. In truth, CEO Andrew Rees has done an exceptional job at Crocs, transforming the product into one of the most desirable brands around, and that brand strength can be seen in the company's pricing power. Let's assume Crocs can grow its annual revenue by 5% a year for the next 5 years and maintain its net income margin of 20%. That would put net income at $1 billion in 5 years' time. If the PE ratio can climb back up to 15, the market cap would be $15 billion, and that works out to an investment return of 19% per year. That looks like a solid return, and Crocs looks like a solid buy. But these are my personal opinions, not financial advice, and I do hold shares in the company. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.